Okay, so we covered depreciation. This is an example of a deferred expense, meaning that the cash was transacted first and then the expense is taken later. Deferred revenue, should be review. Okay. On December 21st, our company is paid $600 to provide service. Okay, so we're going to receive cash, 600. And again, we have unearned revenue. What kind of account is this? Is it an asset? Is it a liability? Is it a revenue and expense? What is it? A liability. So this is a credit normal account. This is a liability. Okay, so now at the end of the month, okay, we're now doing our adjusting entries. We are the accountants. We got to make sure our financial statements are accurate for the period. We're going to now do an adjusting entry to recognize unearned revenue. So let's say of this, this is 30 days of service. So from December 21st to December 31st, how many days have we earned? 10, right? 10 out of 30. So how much of the 600 should we recognize? 200, right? 1/3. $600 times 10 days out of 30 days, which is 1/3, is equal to 200. Again, dig back to whatever, 7th grade math or probably even 4th grade math. Okay. I assume you can all figure this out. If you can't, then we got some deeper issues to work out. And maybe, honestly, if you can't do this math, maybe accounting is like not the field you should be in. Okay, so you should all feel comfortable with this. This is like literally like elementary school mathematics. Okay, so there's nothing wrong if this is like if you forgot this, accounting isn't for everyone. But this should really, if you want to go into these fields, finance related, this should be nothing for you. Okay, and if it is, then you gotta like spend some time like relearning some basic math. Okay, so this is an adjusting entry. It's dated December 31st. We're recognizing $200 of service revenue. Okay, so is that going to be a debit or a credit? The service revenue. Should I debit that or credit that? Credit. Okay, what's my debit? It's not cash, right? For one, there's no cash that transacted on December 31st. And secondly, we know all of our adjusting entries, they'll never involve cash. So what is it? Unearned revenue. Exactly. We're just reducing this liability because 10 days have gone by. We no longer owe 30 days. We only owe 20 days now. Okay, so just to be clear here, unearned revenue, I'm just going to shorthand it. It started off at 600. We're now going to post this $200 debit. We still owe $400, which is the rest of the 20 days essentially. Okay, so now on our balance sheet, after this adjusting entry, we now have the correct amount of liability. We don't owe 600. If we had not done this adjusting entry, we would have overstated this liability. We would not have owed $600 worth of service, right? So the first correction, I guess you can say, from the adjusting entry is that this liability will be correct. And then let's say from all of our other transactions, we had earned, I don't know, $1,000 of service revenue. Now, when we do this adjusting entry, we'll have $200 more. Okay, so this is what we call the unadjusted balance. This is the adjusted balance. Okay, so we can see that we're going to show more profit, right? Our income statement is now going to have more revenue than it would have shown had we not done this journal entry. Okay, so this is why we need to do these adjusting entries, because they're going to correct some realities that have happened in our business and make sure our financial statements are updated for those. Okay, salary and interest. Okay, so in this case, we had one payday happen here, so that's going to be accounted for in the period because the cash and the salary expense happened within our year. On December 31st, okay, this is actually a little off. This is actually down here, January 1st. Okay, payday is 1 day after our cutoff. Okay, so all these days that my people worked, they're unaccounted for in the as of now without an adjusting entry. So we had all the salary expense from the 16th through the 31st. There's no journal entry that's accounting for that yet. Okay? Because payday is a day later. When the cash actually goes out, it's going to be too late because it's after our cutoff date. So we need to do an adjusting entry to account for this like 2 weeks of salary expense. But yeah, we'll assume that this payday covers all of these days. And these from the 16th onward are unaccounted for. Okay, but we can just consider it half a month because your salary is probably going to be some monthly expense, so you have to account for half of it. Okay, so we're going to have to do an adjusting entry. And again, no cash is involved. The cash is going to happen on January 1st, right? That's the actual day we'll send out the paychecks. So on December 31st, there's no cash. So each pay period is 1,200. So that's, that's kind of how they're going to give you the amount. So basically, this is just like for all the prior ones. You can see this December 15th was covered already. All right. This our unadjusted balance is whatever. What is this? 3,600. Okay. This is our unadjusted. Unadjusted. So now we need to do an adjusting entry. So on December 31st, we're going to have a salary expense, 1,200. What should I credit? Salaries payable. Exactly. It's going to be a liability. Okay, so now when I post this is going to go here, 1,200. I will have the correct, sorry, this is what, 4,800. 4,800. This expense is the correct amount of expense. If I had not included it, my net income would have been too high or too low? Too high, right? It's like you're hiding some expense that you actually incurred. So this will lower, it's an expense that your business actually incurred, and you need to make sure that your income statement is going to show it. Okay, so this adjusting entry will lower your net income, but it's going to make it correct. You don't want to ever inflate your net income. Okay. Okay, what is the journal entry on payday? How about that? So the next day, you're actually going to pay the money out. What's going out the door? What are you paying your workers? Cash. Okay, so cash is going to be involved. So is that a debit or a credit if it's going out? Credit. So 1,200 credit. Should I do salary expense as a debit? No, because I'm paying them for what happened in the last period. So what should it be? Salaries payable. Exactly. Because again, the whole point of this salary expense was to match up the expense in the right period. Because all those were for days within this year. Right? So we want to make sure that the expense related to the period is all accounted for. The payday is for the prior period. So we don't want to expense it in the wrong period. We already took the expense. Okay? Make sense? Okay. Okay, I'm going to skip this. Interest is very similar. Okay. I'll just graphically show you. Okay, so on this date, you're going to receive cash. You're going to have what is it? A note receivable? What do we have here? No, this is a note payable. So On this day, we have a note payable, and we're receiving cash. We have to have the interest for just this period. Even though we're only going to pay here, we're going to have an interest adjusting entry. So we'll have interest expense, interest payable as an adjusting entry. And then here, when we actually pay off the note, okay, if it's 12% interest per year, that means we have how much total are we going to pay it off if we're paying off this loan? Principal plus interest for 1 year. Anyone know? What's 12% of 10,000? It's 1,200. Okay. So you're going to pay 1,000. So what is the total amount you're going to pay off this entire loan? 11,200. Okay. So this journal entry, we're going to have cash going out the door, 11,200, of which 10,000 is going to be the note payable that's paid off. Okay, because remember, at this time, when we first took out the loan, we had a note payable credit 10,000. So when we pay it off, we want to make sure we debit it 10,000 to get it to go to 0. So that's what this note payable debit 10,000 is. Okay? We have some of it is interest for this period, and some of it we already took as interest expense in the last period. Okay, so it's going to be interest payable is going to be part of it, and then interest expense. So you're going to have 4 accounts that are involved in this last journal entry. The interest payable is going to be for this amount where we already expensed. The interest expense is going to be from the cutoff date all the way through the payoff date, which is what this is. And then the cash is going to be the total. These are examples of accrued expenses, meaning that the expense is accounted for as an adjusting entry, and then later the cash happens. Okay, accrued revenue. This one is simple. This one is trivial. We've seen it so many times. So on December 15th, we execute a contract to perform services worth $1,600 per month to be paid upon completion. Okay, so we're gonna do the work up front and then get paid on the back end. Okay, so on December 31st, how much of this contract have we done? The first month of work. If it's $1,600 per month and it started on December 15th, on December 31st, what percentage of a month has gone by? 1/2 of a month. So you've earned half of that monthly amount. So how much is that? $800. Okay, so we're gonna recognize service revenue. $800. What's my debit? It's not cash, right? They're not paying me yet. They're paying me on the back end. So what is it until they pay me? I don't know. I just earned it. That's why I have this service revenue. Unearned means I haven't done anything to earn it, right? So I've done half the month of work. They haven't paid me anything. When did they ever give me cash? Account receivable, exactly. So then when they pay me at the end of the month, let's just do that. Or I guess on January 15th, they're going to pay me. I'm going to get cash of how much for the whole month? 1,600. Okay, so then what are my debits going to be? That 1,600, is it just for January? Because this is going to be on January 15th. So are they paying me for work that I did fully in January? No, half of it is for December, right? So I'm going to clear off this account receivable, 800. What's this other 800? Service revenue, exactly. Okay, so I want you to think about what the next journal entry will be. With this chapter, we're just doing kind of this part here. But really, I think a lot of the times the challenging part is figuring out what the journal entry will be when you actually receive the cash. Okay, so you should be thinking about that because, I think some of the questions maybe even will ask you for that.